Channel patterns are one of the simplest and most predictable forms of patterns to trade. Stick around to find out why. How's it going, guys? Ryan here with another episode of My Trading Guide, and today we're talking all about channel patterns, the basics, and how you can take advantage of trading them. But before we get into that, please remember to like this video. It helps me out so much, and subscribe for more content. And with that, guys, let's get straight into it. So what is a channel pattern? Now, a channel pattern is effectively where the stock price moves between two parallel trend lines consistently in one direction and effectively forms a channel. And this is an extremely good pattern for timing your entry and exit points should you be able to determine what direction the channel is going. If the stock price exits the top trend line or the bottom trend line, effectively this is considered to be a breakout, and this can be both bullish and bearish. So I want to show you guys three different kinds of patterns which are considered to be channel patterns. The first of which is the ascending channel pattern, and this is considered to be a bullish pattern, and as you can see, the price is going up and down in an upwards direction. The next is a horizontal channel pattern, and this is where the price doesn't really move too much and it's just consolidating sideways in that direction. Then the final one is the bearish descending pattern, and this is where you can see a channel is forming but it is going in a downwards direction. Now, profit is easily made off all these different kinds of patterns, and as you can see, it helps you determine whether there is a good entry or exit point on a stock when it hits those support and resistance lines. So if you do identify one of these patterns, make sure you identify it at the right point. Here is a real life example of a stock which has both an ascending and descending pattern within it. Now, I don't know if you can spot the patterns, but it's pretty straightforward. Essentially, on the left hand side you can see the downwards channel forming, and this goes all the way down into the dip, and then you can see the upwards channel pattern or the ascending channel pattern form after this. And this is a beautiful example of a change in the direction of the trend quite significantly, and what these channels actually do is confirm for you that yes, the pattern has actually changed. And these are relatively easy to identify after you've seen a few weeks worth of trading if you're looking at the day type charts, and they assist you in determining whether or not a stock is likely to increase in value or decrease in value, and whether or not the pattern that you're seeing continues or changes. Now, what's very interesting is on the left hand side, on the descending pattern, what you can see is a breakout occurred but in the south direction. So the price dropped quite sharply towards the end of the pattern, and you can see it drops well below the end of the two parallel lines, and as a result there's a short period of volatility and a bit of consolidation, and then you can see the ascending pattern starts to form, and then it goes quite a ways up, and at the very end you'll see that once again drops off and it's off screen, but it forms another descending pattern. Now, what's interesting to also note is that on the left hand side as well, on the descending pattern, you can see that there was a period of time towards the center where the stock price actually went through the resistance point at the top. Unfortunately, it doesn't look like there was enough volume at that point in time, so this is what would consider to be a false break or a false breakout. And what this actually is a good period for you to understand that, okay, it's gone above that resistance point for a few days at a time, but then it's come back into the trend, so the trend is definitely going to continue. Further down, you then see some further uneasiness towards the end of that pattern where it drops out the bottom but then comes straight back into line. But then that is where the transition occurs into the volatility and then eventually into the ascending channel. Now, this information's all well and good, but how can you as a trader actually take advantage of these patterns? And as I said before, it's all to do with the entry and exit points of the stock. What you want to look for is the channel itself and the direction that it's going in. So if you're going long on a stock, you want to identify purely the ascending patterns. So if you take that, for instance, it hits the top line or the resistance line of the ascending pattern. That's not where you want to enter the stock. You want to enter the stock when it bounces off the resistance. I'd recommend that you confirm that it has bounced off that resistance point and not broken down through it, in order to confirm that the trend is going to continue in an upwards direction. But what this does is effectively gives you the best bang for your buck when you're entering a stock. If you're going short on a stock as opposed to going long, then you want to do the complete opposite. What you want to find is a descending channel pattern. And the reason for this is because you want the price to keep decreasing because you're shorting that stock. So where you want to enter is effectively when it bounces off that top resistance point and then continues in a downwards direction as confirmation, and that's when you enter. You want to be entering just after that confirmation that it's bounced off the resistance and is heading back down towards the support has occurred. Then the best thing to probably do is then finish your short when it hits that line where it's going to bounce and then increase slightly more. If you really want to take a punt, what you also can look out for is breakouts of the trend line. So if you're bullish on a stock and you can see the price has gone outside the top resistance trend line and it has significant volume and has jumped up in value quite a bit, then that is something you want to buy because it's likely to increase over the coming days. Conversely, if you're shorting a stock and it goes through the support line, that's where you want to make sure you're shorting that stock as much as you can and then making sure you take your profits at a good point in time so you're not risking your own money. Conversely, if you're trading a stock and you see, or investing in a stock and you see that it drops out of the trend line and you can see a reversal occurring which goes against what you're trying to do. So if you're going long on a stock and you can see it breaks through that bottom support point, then this is a great indicator for you to get out of that stock so that you can conserve your profits and cut your losses as quickly as possible if that's the case, or make sure you don't lose as much money as you have on the profits you've already made. And that wraps it up for today, guys. I hope you enjoyed the video and got some value out of it. If you did, please leave a comment below and like for more content. And remember to subscribe to keep up to date with all the latest videos. And with that, guys, I hope you have an awesome day. See you next time.